Good morning, everybody. It is June 19th, 2020, and we are going to talk about energy and solar power today, a little bit in the context of coronavirus and the work at home economy, some places where there are some huge risks for investors that they may want to escape from if they are stuck, or happen to believe that there's good things coming to certain spots, and then some places to build positions. And we will talk about Enphase, which came under a short attack this week, and then really what that means, how I see the company at this point. It has been a conviction long investment for a couple of years, and I think that probably we need to reconsider the risk levels, at least in the short term with that company, and maybe even the intermediate term. Not completely rethinking my position on the company, but as a risk management tool, we need to evaluate in real time, right? Looking backwards gets a lot of people in trouble, like Exxon investors and Altria investors, who are both down 40 to 50% in the last 5 years. So we will take a look. And as usual, we will start with our look at what's going on with coronavirus right now. This is the United States, and the average daily deaths right now is right around 700. So that's good. It has been coming down. And remember, this peak in here had to do with New York City and surrounding area. And as that got better, the country got better. But now the improvement is starting to level off. And this is just the first wave. So they're projecting the first wave, and this is the MIT machine learning that's been spot on. It adjusts it in real time with real numbers, real behaviors, and it's been very, very, very good. So right now we are seeing that if we can manage the infection rate to not let it rise, right now, slightly more than one person gets it for every person that has it. So right now it's 1.05 people get the infection from one person who has it. So the mathematical way to look at that would be for every 20 people that have it, 21 end up with it next. So it is spreading, but it's not at a high rate. If we can stay around here, we probably avoid catastrophe in the sense of overwhelming the healthcare system. But if this number ticks up to 1.1, 1.2, 1.3, 1.5, hospital systems will get overwhelmed. We're seeing that in Houston right now. So the three emerging hotspots are Florida, Texas, and Arizona. They're setting records for new infections. Part of that, yes, is more testing, but the percentage of people testing positive, which may be in here as well, has been staying relatively constant. So about 5%. It was about 5.6% a few weeks ago. Of the people tested, it's still around 5% are positive. If this number keeps coming down, that's great. But this is the number that's really the most important. Because if this, again, and we talked about this way back here, when I was opposed to reopening for another month, we wanted to get this number down to 0.5. Never happened. And now we're back above 1. So more people getting it than having it. Just slightly, but a reality. And it would be good to get this back down to 0.5 as quickly as possible. I don't know that there is any will for the balance of this year to do that, or at least until the second wave comes. So this death projection is around 200,000 deaths by October 1st. And that's without the second wave hitting. So as the second wave hits, probably after Labor Day, is what 3 separate hospital systems have told me, and what I've read from a half a dozen others, including Kaiser and Cleveland and a bunch of others. is that this curve will bend back up after Labor Day. So we're probably still looking at a total of 300-ish thousand deaths, maybe more if the second wave is severe. So there's been a lot of calls to remind people to wear their masks, but there is some sort of weird social or political or ideological affiliation going on with people who choose not to wear masks. I don't know what they're affiliating with exactly, but there is a sense of, with this group, of somehow my defiance defines my freedom, something along those lines. And, my argument would be, dude, it's a mask, it's a pandemic. Could you just wear it for a few months? That's what my hope would be, but we're not seeing it. So right now, it looks like this is leveling off as people socialize more, and the machine, the AI, is concerned that this isn't going to turn down. And it looks like, that is something we should be concerned with. If this doesn't keep coming down, we're in kind of a world of hurt. And judging from the fact that it's the Sun Belt states that are getting hit hard right now, clearly the sunshine and the warm weather isn't terribly helpful. And we sort of knew that from data around the world. The second wave is actually hitting Asia right now, just starting, and they're fighting back hard. Clearly, some of those governments, because the cultures aren't as free as we think we are, they're able to hold it down a little bit better, I think. The numbers support that. So at some point, because we're not going to take orders, we have to accept suggestions. And I'm hoping that we can do that without having to reclose much of the economy. One of our doctors mentioned that maybe it's the air conditioning systems indoors. Yeah, we've talked about that in earlier webinars 2 months ago, that that in certain buildings, the shared air can be a problem. Now, in general, HVAC systems are pretty good at cleaning things up, just because it's obstacles. However, they're not geared to filter for viruses. My guess is that changes in the future, and there's probably some investment themes along that route. So what I'm going to talk about today is energy, and in the context of the work from home economy and what we're seeing with oil, and then we'll shift into solar in particular. Here's my shameless plug for somebody else. This is a webinar that I watch most mornings. I'd say 3 times a week, sometimes 4. This is Dale Pinkert and several of the people that work with him at Forex Analytics. This webinar is free. So if you sign up for a free account at Forex Analytics, you can watch this for free every morning live. And it's usually up on the web later in the day. So I would encourage you to see this. This is my last interview on March 16th. And I would point this out. That was the day that I suggested that we would see lows in oil in coming months. And I said that it would approach single digits. It obviously went negative about a month after this interview. In fact, 5 weeks after this interview, oil was negative. So it blasted right through the single digits. And that represented the fact that somebody had to carry that oil away. So you had to pay for that. This is also the day that I put out the alert. I was on air at about 8:20, about 10 minutes before the market opened. Might even been like sooner, closer to the market open. But they were asking me about, did I have any other ideas? And I said, yeah. I said the gold miners are set to explode because of the years of consolidation and the fact that they have really right-sized and streamlined their businesses. Newmont and Barrick are monsters in that industry, and they've combined on their Nevada operations. So I suggested that gold miners in that scenario were a good investment. And then with the Fed and other central banks printing money, they became a great investment. And as the market was opening, he said it's opening at $17 a share, 16.60, whatever it opened at. And I said, I'm going to buy it right now. While I was on the air with him, I went on, bought. As soon as I was off the air, I sent out the buy recommendation within 20 minutes. So, you know, some of these webinars end up becoming pretty valuable. So today I'm going to talk about some investing ideas. The first one is get rid of your goddamn oil stocks. Okay, I did this interview with Seeking Alpha, and I would suggest that you watch this one too. The price of oil is going to be low for a very, very long time. Now, is $40 a barrel more than zero? Sure, but can American oil companies profit at $40 a barrel? No, they can't. They can barely keep the doors open at $40 a barrel, and most of them can't. You know, we're about to see more high-profile bankruptcies. And of course, the small companies have been declaring bankruptcy for, you know, months and months and months now. So even before coronavirus, I didn't see the last count, but it is a big number. 50, 40, 50, 60 oil companies in the last year have gone bankrupt. You're really getting rid of most of the small players who have to do drilling. Now, of course, your conventional wells that just sit there and pump, and they don't have to have any expenses. They're hanging in there, and those wells are easy to temporarily close. But the frackers, huge problems because of the debt, and that is we're seeing that in Occidental. Warren Buffett's taking a haircut on that one. Carl Icahn's taking a haircut on that one, but it has rebounded a little bit. And I would encourage people of any high debt fracking company, take this rally to get the heck out. The glut in oil is the biggest in history. If we stopped getting oil imports in America, it would take us 5 years to burn off the glut. 3 years. If we had a 1 million barrel per day deficit, it would take 5 years to burn off the global glut. So the idea that we're not going to have an oil glut in a year or in 2 years is completely wrong. It is ignorant of the numbers, or just people who don't care about numbers. So this oil glut's going to persist, and at some point, Saudi Arabia takes its foot off the brakes and just says, let the chips fall where they may. I suspect that is relatively soon, though. So if you haven't been to Bloomberg New Energy, you should take a look at it because they cover a lot of things. Back during CES this year, I talked about hydrogen and where the opportunity was. I talked about electric vehicles, right? They're having a little bit of a slowdown now along with everything else, but the long term looks good, mainly because of the production side. The production side is moving in that direction. So if that's what they're building, that's what they're selling. And then the massive clean energy costs are providing, you know, quite the opportunity, sort of in the face of COVID, to be the new energy sources of the future. And I would suggest this is where I want to start when I talk about Enphase, because one of the short arguments was that they couldn't possibly be lowering their expenses that fast. And there's two reasons why that criticism by the short seller was probably wrong. But let's go back to oil. This is a chart of oil going back to the start of XOP. Peaked in 2014, Saudis started to pump oil. And now for 5 years, oil stocks have gotten beaten up with 1 wave down, 2 waves down, 3 waves down. Now, I'm going to show you something else. Normally, people would think that, okay, well, a corrective wave is generally three waves, and that's not always true. Oftentimes, there are 5 waves down, and that happens usually in secular declines. Oil is in secular decline. We know this to be true. Anybody still arguing with that just doesn't want to understand it. The numbers are overwhelming. The oil is in secular decline. I mentioned in that interview on May 1st, I had another interview on May 1st with Forex Analytics, and I said that we might have seen the peak in oil demand. And I said it in the Seeking Alpha interview as well. I'm not sure about that, but here's what we know. We know that work from home is going to increase significantly. And about 60% of the oil used in the United States for cars is commuting to work. So we can see somewhere between 500,000 barrels per day permanent loss up to about 3 million barrels a day of permanent loss for American commuters. That's a lot of oil that we won't be using. It's a significant, significant drop. So if the United States, let's say, is using 1 million barrels, and right now it's about 8 million barrels a day less that we're using. But let's suppose that America permanently uses 1 million barrels a day less, and there is zero growth. That means that that eliminates all the growth that there was in the rest of the world for the last several years. So that 1 million barrels a day that we don't use anymore, that's all that the rest of the world had been adding on an annual basis. That means that we probably were roughly at peak oil demand late last year. And I think people need to understand that if anything else, we're on that peak oil plateau, what I dubbed it 6 years ago. I called it the peak oil plateau that we would get to starting around 2019. And, you know, it looked like I was probably a year too early. However, I thought the plateau would last a very long time, 15, 20 years. As it's turning out, we're probably on the peak oil plateau right now. COVID probably got rid of oil growth, oil demand growth in the intermediate term, and electric vehicles are going to get rid of it in the long term. So the question becomes, when does oil demand actually turn over permanently? And it looks like the answer is late in the 2020s, right around 2030. Because we know that the gasoline-powered cars are much more efficient. That your big car companies, Toyota in particular, is leading the charge in hybrids. So average mileage going from 30 miles per gallon up to 50 miles per gallon. That's a huge decrease in oil used. So this wave chart, within each wave of a 5-wave decline, you have 3 waves. 1, 2, 3. 1, 2, 3. 1, 2, 3. Pretty easy to see that, right? So now we're getting 1, 2, or is this 1, and then 2, and then 3? This support area, this resistance area here, right? Look at where this Fibonacci line hits over here. It's almost right where it bottomed back in 2016. Came up, hit a fib level, right? Does it blow your mind that this just keeps happening, right? We do these charts and we look at the Fibonacci levels, and these are areas that naturally gravitate with price. So we do this, and it came down all the way to this bottom Fibonacci level. Look at that. Okay, now this is just how you measured it, right? You measure from here to here. But when you take a look at this retrace, from this high to this low, excuse me, from here to here to here, so I wanted to measure a downtrend, not an uptrend. Low to high to low. Look at where these lines fall right now. It is not hard to see that right in here is probably a topping area for this fund. Now, I would argue, and I want to magnify this down to the daily chart, I would argue that maybe what we're seeing is 3 smaller waves. 1, down, 2, 3. And maybe we're heading back down. So maybe this X is actually over here. These are not well-defined waves, so it's hard to know. You know, my original projection was expect some volatility going into the election, maybe some missiles flying. But looking at the individual components, when you take a look at all these stocks, you see there's not a lot of upside in any of these. Bad chart after bad chart after bad chart, huge debt after huge debt after huge debt. And the XOP, oil and gas exploration, has tilted recently towards the natural gas companies. We talked about that a few weeks ago. Why is that? It's because we know oil demand is falling, but natural gas is still ticking up a percent or two a year as coal-fired power plants come online, and not everything is replaced by alternatives. About 2/3 is replaced by alternatives of the coal that's being retired, but about 1/3 goes to natural gas. As buildings become more efficient, things like that, you're not seeing that much growth. And that is something that, you know, will never change. So even though we're going to more remote locations, what we don't spend at the office, we probably spend at home, but only partially because we already had the lights on at home, right? And the kids all had their computers going 24/7 with 3 other devices. But the natural gas companies are starting to fill out the top of this fund, this ETF, mainly because they don't have the secular destruction yet that the oil companies have. So they're going to hang in there and be able to pay their bills. The reason I like the pipelines, because they're going to, the gas pipelines, Kinder Morgan in particular, but I could make an argument for Williams, is that you have natural gas companies that can pay their bills. They're not going to go out of business, but they're not going to throw off a lot of cash either. So, you know, it's really just a slow death for all of these, but it's a slower death for the natural gas companies. So I would suggest that if you are truly risk averse, you probably take the next bounce up, because it could definitely bounce up off of this line. XOP, if you're in it, it's your chance to dump it. I mean, it's almost doubled off the bottom, right? I mean, just look how stupid this is. Got all the way down to the low 30s, and now it's pushing 60. Sell it, right? You're not getting back up here. Not going to happen. Why? Because I can go through the list of all 53 companies or whatever it is, 56 companies. I looked at it this morning over on the Spider website, and there's no doubt in my mind that 1/3 of these companies are going bankrupt. Half the industry is going bankrupt. The little companies aren't in here. But 1/3 of the companies, 20 companies probably, of this 56 are going to go through a bankruptcy. And as you know, I think the Exxon is going to get crushed. And you just go right down the line. Their South American assets aren't going to produce as much. These guys are better managed than Exxon, but they're not going to do anything special. Concho will hang in there because they're Permian only. ConocoPhillips has too many assets. They've probably done as well as they can do, but they don't have a lot of risk either. So, I think they just drift down with the general trend over 10 or 20 years. EOG, again, low-cost producer, but they're running out of low-cost wells. Some of the refineries are okay while oil prices are low, but in the long run, their petrochemical businesses are suffering. And then eventually their regular refining business will suffer. So you don't want to stay in these terribly long if you're in the refiners. Apache, they have some good assets. I think somebody buys them. The rumor is Chevron. Parsley Energy, I think, gets absorbed or merges into a Pioneer or a Concho, something like that. They have complementary assets. Marathon Petroleum Corp, if I was going to own a refiner, this is the one I would own. I just like their mix of assets. The mergers over the last couple of years have been good for them. So you go right through the list. There's a lot of bad companies. I still think Occidental is a coin flip for bankruptcy. So if you want to speculate, the oil has a longer future, that's fine, go ahead. I think the top side for this fund is 85-ish, and I'm not so sure it gets there. I think this 65 area where it just was, that might have been it, and these might be compact, crappy little waves. 1, 2, 3. We'll see. But ultimately, this fund ends up in the teens at some point. It's 58 right now. It's going to the teens. Now, every time I say something like this, I get told I'm nuts. I got told I was nuts when I said Altria was going to head straight down for 5 years. It's down 50%. The first time I ripped on Exxon 4 or 5 years ago, down 50%, 40%, whatever it is. Right? GameStop, we flipped that one. Wrote it up, sold it all, said it was going to crash, lost 80%. There's a whole list of my articles that tell you which companies are crap. I just put up an article with 10 companies or 13 companies that I thought could cut their dividends. Got told I was dumb. I didn't know what I was talking about. Look, I make mistakes, but to say that I outright don't know what I'm talking about, I may miss something, but if I say it, it's more likely than not that I know what I'm talking about for the most part. Again, I make mistakes, but I don't open my mouth on stuff that if I haven't done a lot of research. So some of these people who spend 4 hours at a computer copy and pasting and then changing the words around and saying I'm a bull, the stock's going to go up. There are a lot of craptastic pretend analysts out there. They wouldn't understand a business if they were given the keys to run it. So look at these companies as a business that you were going to run. And you had a fiduciary responsibility to the shareholders. How would you succeed company to company to company to company that you invest in? It's a lot more clear how you should invest if you think like, what would I have to do if I was the owner operator of this company? Buffett talks about that all the time. So when I research companies, and the reason why I only do deep dives in about 50 companies a year is because I get to know these companies. Now, granted, I learn industries, so that makes covering the companies a little easier. But of the 200 or so stocks on our watch lists, I'm not doing a deep dive on every one. I know the industry is good generally, and I know that this is a leading company if we're looking at it, and then I keep track of it. But you know, you see a company like Enphase and you say, okay, somebody's got a big criticism of it, a couple big criticisms. I should look into that. Did I miss something? So let's move over to solar. That's a good growth chart, isn't it? Look who's leading the way. And I said this to you a few years ago, that utilities would lead the way in solar energy. And that's what's going on. Utilities are tearing down coal-fired power plants to replace them with solar, wind, and batteries, and building huge transmission systems. Now, the transmission systems are underbuilt right now, and they're not smart enough. So we have a huge opportunity in the transmissions industry. Who's building what? There's an investment opportunity for you to look up, right? And I ask you to do some of the looking up, because I'm one guy, and even though I use I do use an AI. I use an AI to help me with the research. So I can tell the AI, look for this keyword, look for this phrase, look for things related to this phrase. It's pretty cool. There's actually a website out there that you can do it. It's called Sentio or something. I got mine private, but it's what I need. And I would ask all of you who are industry experts or you have experience in something, take a look at your industry all the time and share what you're seeing in our chat room, or send me a quick thought, right? 3 paragraphs, 4 paragraphs, 5 paragraphs, send it to me in an email, and I'll wrap something around it and I'll put it out there for everybody. This is what, you know, give your credentials, and that will help us all. That's what makes the data aggregation, the social, you know, aggregation of information valuable. You know, Seeking Alpha does a very good job of that, but because they pay, right? Because it's not free anymore, right? I mean, the authors get paid. You do get people who are just, you know, writing something half-ass, half plagiarized, half regurgitated without much original analysis pretty often. So I'd ask you, I'd challenge you to think about how they're making their deductions. So in that article the other day where I said cut these dividend stocks, I was told I was wrong. That most of these stocks wouldn't cut their dividend. And lo and behold, one of them cut their dividend 43% today. So, and then one of them actually cut half before I published the article because I missed it. So 12. Of the 12 companies, one's already cut and one's about to. Think of it like an owner. What would you have to do to keep the business running? And in the oil industry, you're hard pressed to do anything but shrink, right? Remember the George Costanza thing I put up? Shrinkage. Oil industry is going to have shrinkage for a long time. Solar is going to have growth for a long time. It's still a low single-digit percentage, right, of total energy that we use. Now, 15.7 million homes, that's about 10% of homes, I believe. I actually dragged it over here at some point, but there's a lot more homes, right? And this doesn't mean 15 million homes are using solar. It just means there's enough gigawatts from solar to do 15 million homes. We would need 10 times that much for the homes. And then there's all the commercial buildings and all the industrial buildings. So this number is going to grow 20 to 30 fold in the next couple of decades. It's a lot of growth. It provides jobs. It's a huge build out. It's early in the ramp. And it's led by falling prices. And we'll transition over to Enphase. The idea that Enphase couldn't cut their expenses dramatically is silly. Not only did the technology that they have from 2017 to now get better, right? There's even a better curve than this because they're inverters, not panels. But when you manufacture anything, more of it, it becomes more efficient. So early on, you have startup costs, you have learning curve, and you don't have quite the efficiencies of scale that you might have a year or two later. And that's what's going on with Enphase and really everybody else in the industry. And they're passing on the price decreases slower now because they're already competitive with fossil fuels. And in fact, they're starting to capture more of the savings than they pass on. So if a unit of something goes from $2 to $1, because $2 is already competitive, they're keeping most of that $1 in savings. Drops straight to the bottom line. That's going to be going on for a while, although they will run into physical limits at some point, and that's probably in the next 5 years. So new solar capacity has grown quickly, right? Coal hasn't had an up year since 2014. Solar just keeps having up years. Wind keeps having up years. Natural gas is having up years as well, but taking from coal. So here's your three winners: solar, gas, wind. Solar is the biggest winner. The yellow is going to keep getting bigger. The green probably stays about the same because we're adding some offshore, and then natural gas is going to shrink. And a lot of this is geothermal. It's in all 50 states, right? Getting to be more and more. Then COVID-19 has had a significant impact in the very short run, right? So like oil, big drop, and it's going to rise quickly again. And I would suspect that by summer of 2022, this line actually is higher than the current baseline. I think that by next summer, because I believe that we're going to be able to mitigate COVID-19 by next summer, and not necessarily a vaccine that prevents COVID-19, but at least a vaccine that reduces the symptoms. As soon as we have that, this line starts to shoot up. So I actually think this is going to move sideways, more sideways, and then shoot up at the very end of the year because that has to do with tax credits. And that's an important thing in the Enphase story as well. Tax credits matter. So this will start to shoot up back up at the end of the year, probably level off again, then shoot back up in 2022 and break through before 2023. So sometime in 2022, I think that the actual is above the projected. So costs are still going down. And now that you're starting to get people paid, right, your contractors and whatnot, everybody knows that this is cost competitive with fossil fuels now. So as prices come down, they're capturing more of it. If you're looking for an industry, if you're a roofer and you're not looking at becoming a solar installer as well, you are missing out. You ought to go out and hire a couple of people who understand how to do the systems for connecting the solar, and not just installing it, but connecting the system, the energy management system into the house's electrical system. Again, that's what Enphase does. Storage is increasingly being paired with all forms of solar, and that is something that we already saw happen. And I believe, again, this is understated, I believe that over half of solar is going to have storage by the end of the decade. So this will be at least half dark blue by 2030. And in fact, it might even be closer to 3/4, because solar, unlike a car, which has a contained space, solar, you can have a bigger battery. Why? Because you have more space. It's just stationary on the ground. So if the choice is between a more expensive lithium ion battery that's small, right? You could put it on a wall, versus something the size of a refrigerator that's cheap and just as effective, maybe even lasts longer and is less toxic. People are going to say, I got refrigerators in my house, I can add another one. It'll be my power source. The utilities, right? You can take the battery systems and just plug them into each other one after another. Click, 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 click. They snap together. And that's what they're doing. So we know that we can make the grid about 90% renewable. It can be done. There's absolutely no doubt logistically that it could be done. So the question is a good one. What is holding it back, right? So I would suggest that you go and read this article. It just came out today, and I only glanced over it once. But I think that if you're not spending some time on Wood Mackenzie's website, Green Tech, right, Green Tech Media, you're missing out, because these are some of the best investment opportunities in the world. And the results prove it. So let's take a look at the solar ETF going back a long time. Okay, so it collapsed here. I wasn't in it back then. I called this collapse on Market Watch. I bought a whole bunch of solar stocks in here, including Sun Edison, which subsequently went bankrupt. Rolled it up, sold it. Solar crashed again. So let's take a look at just a weekly chart. Let's not make this so hard to look at. There you go. And stretch it out a little bit. So when we take a look at this chart, and I can get rid of a whole bunch of these lines for you. They don't matter all that much. I don't know why that's there. There you go. Oh, that's a fib level. Okay. We take a look at this chart. We try to figure out, where is this going? Well, we know that the last couple of years, the trend has been up. So here's your pivot point, which is where I did the measurements from. And we can see that this fib level ended up being important. There are fib levels that go all the way back, right? These are the ones I'm using because this is the time frame that I care about. Why do I care about certain time frames and not others? It has to do with things changing, right? The time frame from 10 or 20 or 30 years ago doesn't matter so much, even though a lot of people who criticize solar say, well, I remember solar in the 80s, I ain't investing in it. Well, okay. So you could have bought it in the teens and doubled your money in 2 years. It came down with COVID, and it's been ramping back up. It's at a resistance level now. I suspect that we're going to get this correction relatively soon finally, that this rebound rally went on a month longer than I thought it would. And it went higher. Had I known it was going to go this high, I would have participated more. But the risk out there is huge and real, and every money guy out there from from Chairman Powell to Jamie Dimon to Warren Buffett holding a record amount of cash, to Stanley Druckenmiller to Jeffrey Gundlach, they're all telling you you shouldn't be long stocks. Not a lot of them anyway. Jeremy Grantham, GMO, who called both the last two crashes and forecast this early, said this is not only a time that you want to be net neutral to market or even negative the market, right? You want to be inverse the market almost, is what he said. He said, with the exception of a handful of emerging markets, which we're going to look at in coming weeks, there's almost nothing good to invest in right now. And it has to do with valuation and the idea that we're going to get a V-shaped economic recovery. It's not going to happen unless you think of the V as, just a really long V, that takes until 2022. I suspect in the fall we start seeing rolling shutdowns in cities and businesses. The businesses continue to struggle with how to stay productive and have profitability. So with TAN, I would be selling covered calls right now if I hadn't already done it. I actually sold $35 covered calls. You can get a better price by selling 40s, and if you want to be real conservative, sell 35s as well. But I would be selling covered calls and or trimming your TAN position because that's been one of our core holdings. We've had a great rally here, right? I presume nobody bought right up here because I was telling everybody to sell. So if you bought in here, trim, take some of your profits or all of your profits, take all your profits off the table maybe, and then sell covered calls against what's left. And then when it comes down, sell puts. Why? Because you're already going to have a position. Cover calls will expire. You can sell puts. And you can even, if it gets all the way to the yellow zone, which I think it will, but if it only gets up in here, sell the puts, right? Because then your net cost is in the yellow zone, right? If you sell a $28 put and you get $1 for it, your net cost is 27. That's well within our buy area, our buy zone. Take a look on a daily chart to make it even easier to look at, I think. Right? So correction into here. I don't think it sets a new low. I'd be shocked if it did. But I'm pretty comfortable selling $28 puts when I can get a price. I'm even pretty comfortable selling $30 and $32 puts as long as my net cost is in here. So if I want it put to me, I set a higher strike price. And then you can use duration into the fall for sure. I wouldn't sell these puts beyond the election because I've been projecting a landslide for the Democrats since about a little over a year ago. And I think that's going to play out. I think it's pretty clear to me it's going to play out that way. So go ahead and take your, be a little defensive here in the short term. But after the election or even before the election, whenever it becomes apparent that Biden is so far ahead that there's no miracles for President Trump, that's when the market will turn. So when the smart money says Trump doesn't have a chance, they'll invest. And remember, back in 2016, guys like me said that Trump was going to win. And there were hedge funds and big investors that do their own polling that said the same thing. Those are the people I follow. They've been right every year since Kennedy. So, yeah, Kennedy, they've been doing this for a long time. These private polls have been around a long time. So you want to get long TAN because like Tesla, like Nikola, like all kinds of companies, at some point, The millennials pile into this stuff. The Reddit, right? The Reddit people, the Robinhood people, they all pile into this stuff. And they're going to look for value. And it's hard to find value in technology stocks right now, right? So somebody just pointed out in the chat that Ray Dalio said investors could be looking at a lost decade for stocks. Who else do you know said that? In my annual outlook and my investing in the 2020s presentation, I said that this decade could look a lot like the 2000, 2009 decade, where at the end, you're pretty close to where you started. So that means that your asset allocation has to be in the sectors that are going to win. And what have I talked about? The whole smart everything world, right? And then some resources, water related, agriculture related, some metals. Because capital, if it becomes tighter, and it almost certainly will, is required to get the base inputs out of the earth. And that becomes more expensive when money is more expensive. Drives up prices. So not only are we going to get monetary inflation push, eventually we'll get demand pull inflation, and then the underlying commodities are, if money isn't quite as loose, underlying commodities become more expensive to get out of the ground. So on Forex Analytics today, I didn't go on air. I just sent in some quotes, or some things that I said. I asked them about the dollar. I see the dollar spiking and then trending down for an extended period of time. Now, I don't think the dollar ever collapses. I think there's underlying strengths, but all these things work together. So with solar, huge growth. A lot of the companies are asset light, right? They don't have huge expenses because the production, the more they produce, the unit costs come down. They're going to have to pay the people, the installers, but the installers are just going to keep getting more efficient, and they're going to use machines as well. And what Enphase does is pretty much snap together, plug and play. It's very, very good. They've increased their market share significantly. So let's get into Enphase. But I would be buying this on pullbacks. 30-ish, start thinking about it. 28-ish for sure, you need to jump in. But you can also sell puts. If you sell puts down to this 28 level, I think you're doing yourself a favor, and it's a way to grind out some money now while the market is overvalued. But I would wait till it gets to about 32 before I sold the puts. So if you want, sell a put where your net cost after the premium is in this range. Just set a good till cancel order. If you want to sell the 28s, set a good till cancel order for $1 for September, October, and there you go. Just let it hit when it hits. Whenever the correction happens, you don't have to be sitting in front of your computer. Tell your computer what you want it to do. And then when this wiggles around, it'll do it for you. So the Enphase short. I'm not going to spend a lot of time on Enphase because we're going on an hour, and I'm trying to keep these under an hour. So the short seller said that the revenues were fabricated. Here's the number one reason why he's full of shit. The money's in the bank. How can you fabricate money in the bank? Right? So presumably JP Morgan, which came out and defended this company, has access to be able to say, oh, look, yep, there's the money. Pretty clear. If the money's there, they made it somehow. Now, I read the entire 55 pages, and I will tell you that the level of innuendo and high school style writing blew my mind. I don't know who this guy's fooled They have $27 million under management. But that's what he's done, because he's not very good at what he does. And his assets are down about 20%, 30%. So his main arguments right here is that they were using foreign accounting to make it hard to analyze their data. And I will say this about the CEO. I don't like him. I think he's arrogant, and I think that he doesn't portray things as transparently as he could, and he does it on purpose. And when people purposely aren't transparent, that scares the shit out of me. Right? Anywhere in life. So the CEO is not transparent, and his team isn't very transparent. And this short seller picked up on that. So I'm not saying there's not some smoke here. But what I'm saying is that the cash is in the bank. And at the end of the day, that's what matters. So do I think the CEO, Badri, is arrogant? Yeah. But I think that about a lot of people who are successful. Sometimes I think that about me. So the transparency issue, though, to me is a concern. Now, in this report, he accuses them of having Shatila, the former CEO of SunEdison, as a consultant. I don't know if that's true or not. I haven't been able to find anything on it. If he is a consultant, then the question becomes is, what do you think of that guy? Well, here's what I think of that guy. I think he's arrogant and not transparent. So there's a culture here, when you take a look at the other executives, of clear arrogance and lack of transparency. To me, that means that the risk is higher. That doesn't mean the stock won't go up for a while. It could be a favorite, right? However, let's ask some other questions. Did their expenses come down as much as they said? If you take a look at their investment presentation, and you should do this, I'm not going to walk through the whole thing with you. You'll see some charts in here that show what's been going on with their expenses. So they had $205 million, $210 million of revenue in the fourth quarter, and their revenue basically doubled in a year. Okay? Revenue doubled in a year. So we have to ask a question, how the hell did that happen? When the growth rate in solar was about a third of that. Well, one of the answers is they bought SunPower's microinverter system business, and they changed their accounting rules back here. So they've been recognizing deferred revenue. Well, there was a major deferred revenue event here. What was it? The tax rules, the tax rates changed. But there was a ruling that said if you start a project, it doesn't matter when you finish it, and you have everything bought, you can do the higher tax break on last year's tax return. So Enphase sold a whole bunch of their products, and JP Morgan, in their interview with them yesterday, said they're not channel stuffing. Nah, that's not quite true, right? I think that they're as I'm trying not to use giant words. I've been told that those are hard to understand. Sometimes I say something that people don't understand. I do not want to be the Dennis Miller of investing unless I'm funny, so there's that. But you see how this ramped up. That was distributors and contractors buying what they needed for the next year, packing it in here. That's what that was. So first quarter came down, and it's going to be lower in the second quarter. But then probably because of growth, sometime within the next few quarters, it'll be back up at this level. So expect a little dip down and then back up. And you can just add up their operating expenses, 28.5 million, right? Subtract that from the gross margin of 81.3 million. Operating income, 52.8 million, right? 81.3 minus 28.5 equals 52.8. And everything from 205 down to 81 was their other expenses, left them with 39.5% margin, which I think is about as good as it gets for these guys. They're modeling 35%, so I would expect a little bit of reversion to the mean, okay? And some down revenue quarters here coming up. One of the other criticisms was that their technology was being caught up to, and there's some truth in that. But they're so far ahead right now, right? They have first mover advantage, which, as you see with Tesla, can last for years. Apple had first mover advantage on, on the iTunes. What was the iTunes thing called? Was it called iTunes? The little device, the iMusic thing. I don't even remember what it is anymore. They're able to manage the energy in your home. So they connect your solar, right, to your storage, to your house, and it all works together. So their semiconductor built into their microinverter, it's basically converting the energy at the source rather than tying it all together and converting it in one central location. Why is that important? Because if you convert the energy, and they actually have a comparison here somewhere, but if you convert the energy, right, at the panel versus at a central location, because each panel produces differently, it's more efficient if you convert it at the panel, right, your AC/DC. So I believe these guys are going to grow a lot. So the question becomes, is the price right? And they dropped into one of my buy zones, right, below 40. Then the other buy zone is here in the lower 30s. I think that they have upside to 100 for sure, which means that they could double from here over the next 2-3 years. Are they going to get back into these zones? I think for sure this one, right? It's only $5 away. Right now, you got all the kids out there saying, oh, it's a bargain. And it is kind of a bargain. Look, it came down from 65. I think that this is a pretty strong zone here. This is a pretty strong zone here. So somewhere between low 40s and low 30s is probably where I'd buy it again. I wrote all sorts of cover calls. I bought some of them back. And this is still a company that I expect to grow enough to get included into the S&P 500 in a few years. That doesn't mean it won't be volatile. Look at how big these swings are. It's going to be like that with this company. And when they get a bad quarter eventually, and they will, maybe the next one, it's going to get beat up. So manage your risk. I think that if you are a risk-averse investor, you need to write a lot of covered calls on this and keep it to a small position and sell puts when it's oversold. Otherwise, you just let it do what it does. And when it gets overbought, you got to trim. So the arguments against Enphase were, for the most part, wrong, except that there is that little bit of smoke from the non-transparency of the management team. And for me, that means I'll never make it a big position. 1 or 2% on top of my TAN. So this is my core solar position. It's how I get my first solar exposure and a bunch of other companies I don't have time to research. And I know that the industry is going to do well. And what I want to do as a solar investor is I want to own TAN as a 4, 6, 8% position if I'm also going to buy stocks. And then add another 4, 6, 8% in companies that I like at 1 and 2% increments. SunPower is my favorite. I believe that SunPower is selling their microinverter systems to Enphase, right? So Enphase bought SunPower's microinverters. Why would a smart company like SunPower, which is backed by Total and 3/4 owned, sell a certain business so they can focus, right? So Enphase got to buy market share. They're not using the technology even. They just kind of put it out, into their portfolio of things to build off of maybe. And SunPower now is one of the preeminent companies in the market globally through Maxion as well. So SunPower is the one that I also think is going to around 100. The difference is SunPower is under $10 a share, right? What is SunPower right now? $7.60. And Enphase is 49. I think they're both going to around 100. I think the risk is probably lower with SunPower as well because of their financial backing. Now, Enphase is debt-free with cash in the bank, just like First Solar. In fact, I think Enphase might be in an even better position because I was pulling it up on my handy-dandy, trusty stock rover, and Solar Edge and Enphase are both in a great position, right? Good earnings yield, good EV to free cash flow. Not great, but good. You really, ideally, every company would be like at this level or better. Look at the companies that are at that level or better. There's a couple dozen. There's not a lot of great valued companies right now. They're all expensive. So I would focus on SunPower and TAN, and then look through the holdings of TAN, right? Look through the TAN holdings and say, is there something special about any of these other companies? Solar Edge and Enphase are right there. So you're getting a pretty good slug of all of these companies, right? Sunrun, I think, is super interesting because of their connection to Costco. SunPower. But this is a good fund. So when you own this for 4, 6, 8% of your portfolio as a core position, then you have to decide, do I add more TAN as a satellite position and trade it? Or do I add some of the stocks to overweight those particular stocks? SunPower is the one I'm really overweighting. Vivint's interesting to me because I think they might get bought. But I think they've rallied pretty good. Yeah, they've had a pretty good rally. Down here would have been a good place. There's so many stocks that doubled in the last 3 months that, you look back and go, oh, well, I missed it. Now what do I do next? Well, I can chase it and hope they keep going up. But we know everything's overvalued. We know the put-call ratio is crazy. We know that it's a bunch of young, inexperienced investors chasing returns and trading because they think they're all superstars. All kinds of alligator jaws out there. Will the alligators wake up and snap shut? The answer is yes, but we don't know exactly when. So these guys at Forex Analytics, Dale said the correction starts next week after triple witching. Makes a lot of sense to me, and it coincided with some of those Fibonacci time zones that I showed you a couple weeks ago, a few weeks ago, maybe a month ago. So, all right, I'm going to stop recording, and then we'll do a quick Q&A off air. The Q&As, I'm not really going to record these in general. but I will write about them because I get the transcripts of the questions, and I can, if there's something to expound on in writing, I'll do that. But in general, don't ask me if I'm going to put out the Q&As. I'll write about the important stuff. But in any case, if you like to join up for any of my services, currently, margin of safety is half price. You just got to contact me through my profile. Contact me through my profile and send me a message. There's a way, I can't send myself a message, but there's usually a little message thing here. Send me a message and say, I want half price. Or the ad that I'm using says freedom. So if you go to this last article, cut these dividend stocks before they cut. There's your deal. Let's go to margin of safety investing, $199 for your first year. Renews at $4.99. If I can't earn that, then let it go. All right, this guy's a knucklehead. So love to have you on board, or you can go to fundamental trends, and everything is half price, right? Everything's half price. ETFs, half price. Growth stocks, half price. Retirement stocks, half price. Option selling plus the retirement stocks, half price. Everything that you can eat with swing trading, half price. So, and the super deal is, if you buy this, I'm going to give you the swing trading for free for a year. Because I want you to learn. There's money to be made in swing trading, but it's not as hyperactive as you think. It's 20 or 30 trades a year, and it's focused, and there's reasons behind it, and it's not day trading. I don't do day trading because I don't have the time. Why do I want to spend my whole day trading to get 1 or 2%? I can make similar money with good core positions that I buy and hold, adjust my asset allocation several times a year, and do a handful of swing trades that are high probability. And again, I've averaged between 15 and 25% per year returns for a long time on the retail side. I think you can do better than me because you can take positions I can't take on the retail side, right? I can't do certain things for my retirement advice, my investment advisory clients. Regulators don't like some of these trades, but I can tell you what I'm doing with my money, with my personal money, and then you can go and do it. So I know that people would like more recommendations, but again, I point out, how can anybody give you more recommendations? There's only so many that you can do. Some of the analysts, they cover like 4 ETFs, some of these guys, right? Gold, S&P 500, a couple others. So what we're doing here is high probability in most cases, risk managed. I just pointed out the difference between SunPower and Enphase. Similar upside, much bigger downside for Enphase. So you gotta be very diligent managing your risk with Enphase, and the smoke there is the management. And I don't like that at all. Don't like management that isn't leveling with me. Made a lot of money on Kevin Conroy at Exact because he leveled with everybody. This guy at Enphase, not so sure about him. And his team, not so sure. And the fact that there was some big selling right after the annual meeting by executives and insiders, I don't know how I feel about that. Now, they had a South American investor who basically doubled his money in a year. I understand why he sold. He doubled his money in a year. So that, I don't think that was a big deal. And that was actually one of the criticisms of the short guy, the short investor, is people are selling. Yeah, they have low salaries at Enphase. That's something to know, right? They're not getting paid millions and millions of dollars in salary. They're mainly getting paid in shares. So they got to sell some shares here and there. and they can't do it until after, right? There's a blackout up until an annual meeting. So they did the annual meeting, then they sold afterwards. And that makes sense. Because they didn't sell at the high, right? They could have sold 2 weeks or 3 weeks before the annual meeting and made a lot more money. And they didn't, because they couldn't. So, all right, let me put this on done, and then I will look at some questions.